The basic problem that we have right now is in the last 36 hours, a key part of the financial plumbing of Silicon Valley has basically been turned off. And as a result, billions of dollars of deposits have basically been frozen. It means that people can't pay their bills. It means that people can't access their deposits. It means that credit lines could be in default. It means that payroll can't be met. And so as a result, we have this potential contagion on our hands. But in order to understand it and unpack it, I think it's important to explain exactly how this came to pass.
Hey guys, welcome back to Library of Wealth. Today we have Chamath and the All In podcast discussing the recent collapse of Silicon Valley Bank and why fear in the market is skyrocketing due to not being able to have access to their funds. Regulators seized California-based Silicon Valley Bank on Friday, making it the second largest bank failure in US history since 2008. The bank had approximately $209 billion in total assets and about $175 billion in total deposits. The collapse was caused by the withdrawal of deposits, mostly technology workers and venture capital firms, creating a run on the bank. It's unclear how many of the deposits were above the $250,000 insured limit guaranteed by the FDIC. One of the major problems SVB had, under the Dodd-Frank Act of 2008, it was allowed to invest in assets that were yielding only 2% on $82 billion worth of investments. While this wasn't necessarily a bad decision, the problem arose when these investments became underwater. The bank had invested in mortgage-backed securities, which yielded a 2% coupon on a 3% mortgage, and this became a major issue when the Federal Reserve raised interest rates. With alternatives to move their money, people started withdrawing their funds, and the bank had to sell assets to make up for the shortfall. The bank was not solvent, with $15 billion in unrealized losses, and $3 billion unsolvent at the end of last year. The CEO was selling stock, and insiders were getting paid bonuses up front and early, indicating that the bank was in trouble. Let's get right to the latest interview with Chamath, as he discusses what effect this is having on the market and what we can expect in the coming days. Don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
Can you recall a time in our careers where it's felt this acute or insane or intense?
2008 and COVID.
Okay.
And I think that this is right up there, could be 2, probably 3, in terms of the level of panic and concern. The problem is we're in the middle of it. We don't know what's going to happen this weekend. So there's a lot of anxiety right now, a lot of panic going on, and a lot of, unlike COVID and 08, really acute effects that many companies and investors are actively dealing with right now. Not just a few, thousands of companies that are really in a state of distress right now. So it is potentially, from a Silicon Valley perspective, worse than 08 or COVID.
For sure. I mean, this is basically a Lehman-sized event for Silicon Valley. Remember when Lehman Brothers basically filed for bankruptcy in 2008, started the whole financial crisis. The federal authorities thought that the best plan for Lehman was to file for bankruptcy. They didn't try to save it. And that basically led to a cascade where the whole financial system almost collapsed. I think that SVB, this is a Lehman-sized event for Silicon Valley. And there's 2 big things happening. One is the impact on the startup ecosystem. So you're seeing probably thousands of companies now cannot make payroll in the next few weeks because their money is trapped and tied up at Silicon Valley Bank, which is now under receivership. So if you wired your money out yesterday, you're good. And a lot of people managed to do that, but there are a lot of people who had wires in the hopper, didn't make it. Today, logged into the website, can't log in, their money's just frozen. And we don't know when they're gonna be able to get their money out or how many cents on the dollar they're gonna get. So basically the whole startup ecosystem is in peril. I think Gary Tan called it an
extinction level event.
Yes, exactly. That was a good term. And just to be really clear, this is not big tech at risk. I know there's a lot of people out there who don't like the idea of bailing out big tech.
This is not Google. It's not Amazon.
Exactly. Those companies have plenty of cash. They're fine. This is small companies with 10 to 100 employees. And you're looking at maybe thousands of them just being wiped out for no reason. They didn't do anything wrong because of this. This could have a very damaging effect on the startup economy and the whole United States economy. This is little tech. These are the future companies that will keep the United States competitive versus China and the rest of the world. And then the other big thing that's happening, and this is all happening in real time, is a regional banking crisis. Because when depositors see that their money was not safe at SVB, which was a top 20 bank that, as far as everyone knows, was in regulatory compliance. Nobody has said that SVB wasn't compliant. As far as we know, they had a regulator's seal of approval. And now you find out your money was not safe and it's not FDIC insured above $250,000. So the conversations we're all seeing in our chat groups with leading investors is, why the hell would you keep your money anywhere but JP Morgan or a top 4 bank? And so I think that unless the Fed steps in here over the weekend, we're going to see potentially a run on the regional banking system, a cascade like we saw in 2008.
U.S. Treasuries were at 102. You get like 2% a year. They bought a bunch of those. That was actually, when you think about it, you would say that's a safe bet. The problem is those are locked up for 10 years. And nobody anticipated on the Silicon Valley Bank team that the rate hike would happen so quickly, so violently. Remember, we saw the 25, 25, 50, 50, 75, 75, all those increases. Now, what happens to a 2% U.S. Treasury when the interest rate goes up is they get devalued. They're not worth as much. So if you did need to sell them, you would have to sell them at a discount. If you held them to maturity, you would get that complete return. And what happened here is they needed to sell these early, and they sold them early, and they took a massive loss, billions of dollars, and that's what lit the fuse.
That's the slide I showed, like the price basically
I just want to make sure
down.
the audience understands that.
Yeah.
If they had sold these earlier, or if they hadn't bought these, they would have not had this problem. Go ahead, Chamath.
Now, why in that meeting did they have to decide to emergency sell? It's because VCs stopped giving startups money. So startups couldn't deposit more money into the bank, but they kept spending at the same rate that they were spending.
In other
which
words,
means that
the deposits went down. Yeah.
In the last 18 months, not enough folks read the memo.
Mm-hmm. Yes.
And by the way, the tragedy of that is, let's just say that you did get the memo and you did make the hard cuts right now. And let's say you're working on something and you can fill in the blank on the thing that you care about. Okay. So for the listeners, let's say it's climate change. Let's say it's breast cancer research, whatever it is. This had nothing to do with you 4 days ago. You had your money in the bank. You did everything you needed to do to go and, figure out product market fit, try to get to market, try to sell your product. And all of a sudden, because of some other set of folks and actors who couldn't get their act together, now you're on the precipice of bankruptcy in 36, 48 hours. That's crazy to me.
In a major regulatory intervention, California regulators have caused significant disruption for portfolio companies, putting a freeze on all funds, including wire transfers. Despite best efforts, some wire requests were stuck in a queue and did not make it through before the deadline. Users and investors received the news that they were only insured for amounts up to $250,000, leaving the rest of the funds uninsured. The consequence of this is that companies are now in line as creditors in a potential bankruptcy scenario. The mutual funds they thought they owned were actually held in SVB's name at BlackRock, causing great confusion and anxiety for clients as they try to locate their money market funds.
The California regulator made things worse. The California regulator stepped in and they froze everything. So our companies were in the process. We have companies that submitted a wire yesterday. By the way, we spent all day yesterday on the phone with our portfolio companies trying to get them out. We had wire requests that went in before the deadline, and for some reason, we're in a queue.
They didn't get through.
And they didn't get out. They didn't get through. And then the California regulator steps in this morning and freezes everything. And what did they announce? They said, oh, you're good for your insured amounts. How much is that? $250,000. For your uninsured amounts, which is everything above $250,000, you're going to get a certificate. A certificate? What does that mean? That means you're a creditor in bankruptcy. So the mutual fund that you thought you owned was actually not hypothecated in your name. It was in SVB's name at BlackRock. And so our companies have been calling BlackRock and calling Morgan Stanley saying, hey, do you have my money market fund? And they're like, no, sorry, that's SVB. So
this is the crazy
they're
thing.
Sitting in a creditor line in bankruptcy.
We got to explain this. These were called sweep accounts. So what Silicon Valley Bank did with some of these large portfolio holders, let's say Saks and a bunch of other VCs gave you $30 million. Yes. And they took your money and they said, you know what, just to be safe, we're going to take your money, we'll automatically sweep it and distribute it across 2 other accounts. So we got this BlackRock over here for you, great. We got this Morgan Stanley over here, great. Whatever it is. You could only get to those through the Silicon Valley Bank interface. And so it was supposed to protect you, but there's no recourse, it seems. those are frozen too. So the only thing you can do that's logical, and I had a mentor 30 years ago when I had the magazine and we started hitting millions of dollars in revenue. And I said, how much money do we have in the bank? He's like, which bank account? And he had 4 bank accounts and he would load balance them. And he did it every Friday. God bless Elliot Cook. He did it every Friday for me, and I've always done that. I've always had multiple bank accounts and load balanced them. But in this case, Silicon Valley Bank did it through one interface. I have multiple startups today who did this exact thing, Sachs, and they couldn't even log into Silicon Valley Bank today to even see where they're at.
Well, you have 2 paths here. Path number 1 is if you actually try to sell these assets. But the problem is, who do you think the buyer is? The buyer are the sharpest sharps on Wall Street who will purposefully underbid these assets. And so that then takes you to path 2, which is then the only other real solution is for the Fed to warehouse them and guarantee them. And that's an equivalent version of what they had to do during the Great Financial Crisis, which was this thing called TARP, which is the Troubled Asset Relief Plan. It was just a backstop and a mechanism so that these, at the time, those toxic assets, which were a bunch of mortgage-backed loans, could be cleared through the system over time, which effectively meant that the Fed basically warehoused that risk. So I think what we need to see now is, Sachs, it could be 50 cents on the dollar. It could be 60 cents if you want immediate liquidity. You know, a friend in our group chat was mentioning that there was one claim, a company that had $100 million inside of SVB was offered 60 cents on the dollar today for that claim. Now, that's from a third party who said,
wow.
I will give you 60 million today in return for that certificate plus the 250,000 that says you're owed 100 million, because they're willing to take the risk that they'll get, 80 million,
wow.
right? And then they take the difference. Now, the point is that if you're seeing today that kind of a discount, that's not a good sign, I think. And it does speak to the fact that regulators have to step in. Now, here's the other reason why I think it's important. I think what regulators, and I think the people, and there's a lot of them in Washington that listen to this, what this does is it torches years of US innovation. And you should not let that happen. There are companies working on really important things for the United States and for the rest of the world. And if the company fails because they can't make the product work, so be it. We take that risk every day. If the company fails because customers don't want to buy it, so be it. If the product fails because a better product comes out, so be it. But it shouldn't fail because we can't get money that is in
you forgot your PIN code.
Deposit. Yeah. That should not be why we torch hundreds of startups and what they're working on.
Chamath goes on to say that if companies and startups are not able to access their funds due to bankruptcy, it could result in a significant loss for Silicon Valley. He emphasizes that startups have much to contribute to the US and the world, and it would be a great loss if hundreds of them were impacted.
It's not just about a couple hundred tech bros in Silicon Valley not being able to make payroll, but there's important downstream consequences. For example, there are payment processing companies in Silicon Valley that use Silicon Valley Bank to store their capital and to move money around. There are payroll companies that do payroll for many businesses, not just tech businesses, but many businesses in different parts of the economy that store their cash at Silicon Valley Bank and process money through Silicon Valley Bank. Today, it was announced that Rippling, one of those companies, could not hit their payroll cycle today because they had money tied up at Silicon Valley Bank. Fortunately, they announced that they also have money at JP Morgan and other places. So they will be able to kind of get the payroll processed early next week and get everyone back on track. But this is hundreds and potentially thousands of companies that use their payroll software to process and pay their employees. And then there's all the payment processors. We don't know how many of them have what level of exposure, and a lot of infrastructure companies that move money in and through Silicon Valley Bank. And so if they start to go down and then payroll doesn't hit the air conditioning company that's using the tool in some, in Arizona, and then, the Stripe service isn't able to process e-commerce payments for a small business owner that runs a website, you can start to see how there can be very significant trickling effects. And more importantly, like we saw in 2008, is the contagion of panic, where people say, if there isn't reliability in the things that I thought were reliable before, I start to have real questions in the soundness of the system overall. And that's why it's so important, as Sachs said, to step in, shore up the problem this weekend. I don't think it's about bidding 50 cents or 60 cents on the dollar. Every depositor needs to get paid 100% of their money. And that cash needs to be made available 100%. To them by early next week. And if that money 100%. Is not available to them within the first 48 or 72 hours of the end of this weekend, then we are going to have a real crisis on our hands, because then you will see a lot of people trying to move money away from any institution that stores their money in some sort of security that's not 100% liquid like cash, and that's going to cause a massive run. And so what has to happen, the only way this can happen, is if someone takes over Silicon Valley Bank this weekend, and that the federal government, unfortunately, as much as I hate to say it, because I absolutely hate the federal government having a role in this stuff, has to say, we will guarantee 100% of those deposits to the company that takes over, the bank that takes over this portfolio, and says, let the portfolio of assets run its lifetime, see what you get paid, whatever the delta is, we'll make it up to you, but we need to make sure that there's cash here today for all of these depositors.
Credit risk indicators flashed red on Monday as investors worried about contagion risks across corporate debt markets after the collapse of Silicon Valley Bank and New York Signature Bank in the span of 72 hours. Analysts say uncertainty continues to dog the sector, with investors still extremely worried about the health of smaller global banks, the prospects of tighter regulation, and a preference to protect depositors at the expense of shareholders should other banks fail. Major U.S. banks lost around $90 billion in stock market value on Monday, bringing their loss over the past 3 trading sessions to nearly $190 billion. We'll be keeping an eye on this. What do you think about Chamath's take on the market? And what we can expect from regulators in the coming days? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.